Well, folks, this is a shocking video I am making here today. McDonald's stock is a bubble. Not only is McDonald's stock a bubble, I'm going to take you through most of the Dow stocks are actually in bubble territory right now. And I know that's a hard thing to even fathom or even think about because these aren't the sort of stocks you would ever think could ever be in any sort of bubble, essentially, right? And I'm not talking just these stocks are overvalued, because if you're talking about a stock's overvalued, usually you're talking about it's overvalued by maybe like 10%, 15%, maybe 20%. Its stock price needs to go down. These stocks, they need to go down a lot more. And I mean a lot more than just that. These are in bubble territory, and I mean the Dow in general. We're going to run through valuations. I'm going to show you where these companies are historically at in terms of valuation metrics, PE ratios, things like that. We're going to talk about it from many different angles. Does it make sense that these stocks are trading at massive premiums versus where they ever trade at and those sorts of things? But basically, most of these stocks need between a 30 and 60% drop from here. Let that sink in for a moment, okay? They need a 30 to 60% drop from where they're at right now. And that is downright scary if you're thinking about where the market could end up going over time. And what we do know consistently throughout time is when you have a bubble in the market, it does not stay around forever, and it does end up popping. Every single time, right? And we're always told it's going to be different this time, or here's why these Dow stocks should be valued way more than they've ever been valued in the past in terms of every single financial metric you want to look at these companies. No. Okay. We fall into the same trap every single time, right? And if we go back 2 years ago, it was obviously, hey, who cares about valuations now? It's just growth, right? And we've seen how that's ended. Every single time you get a massive bubble in the market and anything, it does pop, it will pop. And we'll talk about when this is going to happen and how it's going to transpire and all those sorts of things in this video as well, right? And in the market in general, we're used to, like, if you hear bubble in the market, people are going to think, oh, Tesla's a bubble, or Shopify, or Netflix, or Amazon, or those sorts of things, right? And those stocks definitely got up to very bubblish territories, a year and a half ago, 2 years ago, right? And look what's happened with their stock prices. They've come down massively. At the end of the day, if you start trading at silly valuations, you will come down, okay? And the fact is, when I take you through the valuations of these companies, where they should be trading at and where they are trading at, you're going to realize, oh my gosh, these stocks are almost as overvalued as many of the high growth stocks were. And that's the scariest thing, because once again, these aren't the sorts of stocks like everybody thinks about, tech stocks and those sorts of things. So yeah, I hope you guys enjoyed today's video. I hope you get a tremendous amount of value out of it here today. I can tell you I'm the only one that's even covering this and explaining this, okay? And so when you see things go boom, boom, don't forget who was the first one to, explain this and kind of, show this in depth and in what's going to happen here before everybody else kind of saw this vision here, okay? So hope you guys enjoyed as always. Appreciate you joining me. Let's get into this, guys. So first thing I want to start out here is I want to show you what the 2023 growth rates are expected from these different companies. This is based upon analyst estimates, okay? And the reason I want to show you this is so when you see these stocks are trading at ridiculous valuations, you understand these aren't some exciting growth stocks. These are very, very boring, sleepy companies, okay? Now, something also to factor in here is none of these analysts have even factored in if the economy really falls off the rails in 23, which is a real potential, okay? So this is assuming the economy is good. Okay, this is assuming in 2023 the economy is good. These are the growth rates that analysts have for these companies. Okay, United Health 10%. Goldman Sachs 5%, 4% for Home Depot, 3% growth for McDonald's, Amgen 3% growth, Caterpillar 6% growth, 7% Microsoft, Honeywell 4%, Visa 9%. That's a pretty strong grower for the Dow stocks. Like, that's amazing, right? Travelers 7%. Boeing's the big one, 22% revenue growth expected for Boeing. But do keep in mind they're coming off some horrible years. So for them to post 22% growth isn't all that great. Chevron is expected to have their revenue decline by 12% in 2023. 3% growth for Johnson & Johnson is basically no growth for Procter & Gamble. Maybe Honest is taking all that diaper share or market share, okay? American Express, 11% growth, so that one is a small double-digit grower expected to next year, right? A lot of that's going to come down to how the consumer is doing and how much they're going to spend or not spend, right? Walmart, 6%. Good news for Walmart is regardless of, how bad the economy could be or not be, Walmart's going to put up their numbers. That's just Walmart, right? IBM, no growth expected for IBM. JP Morgan, 9% growth expected. We'll see about that. Salesforce, 11% growth expected. Apple, 3% growth expected. We'll see about that. 3M, negative 1% growth expected for 3M. Nike, 7% growth expected. Merck is expected to have negative 2% growth. Disney's expected to have 7% growth. We'll see about that. Coca-Cola, 3% growth on Coca-Cola. Negative 9% for Dow. 5% revenue growth expected for Cisco. 1% for Verizon. 1% for WBA. And negative, I believe it was 9%, shrink in revenue for Intel expected there, okay? So nonetheless, you got to understand these companies are very, very boring, sleepy companies for the most part, and almost all of them are not expecting big growth at all, right? Not just next year, but in future years as well, okay? And obviously, because they're big dog companies, they have a million other companies that want to try to compete with them and try to steal market share, right? The companies that are basically on the come up right now, because at the end of the day, if you got a huge business, there's a lot of companies that are going to want to eat into that, right? I'm sure PayPal and Square would love to be Visa, right? And that's just the way it is, right? And so you're always going to have these competitors. You're going to have a lot of people always trying to beat out Salesforce. And that's just, it is what it is, right? That's a competitive economy, right? Now, next thing I want to show you here is dividends, okay? Because you might think, well, these are great stocks to be in because the dividend, you make a bunch of dividend money, okay? And the fact is, these stocks shouldn't be trading any premiums based upon dividend. The dividend yield on average for these stocks is about 2.6%, okay? Now, in an environment where maybe interest rates are at zero, okay, maybe 2.6% is, okay, 2.7%, whatever, right? But the fact is, right now, this makes no sense to be in dividend stocks or these Dow stocks. If you're just in it for the dividend, it doesn't make sense. And if you're just in it for the capital appreciation, you're not going to get capital appreciation. You're likely going to get a big capital decline here in these stocks, right? And you look at anything like anything from the government, right? Whether you're talking about treasuries or bonds or anything like that, and you look at the yields on this, and these are seen as basically risk-free. That's the thing. Like when it comes to government-related instruments, these are basically seen as risk-free. So you can get a better yield now by just putting your money in something government-related rather than risk it in a stock that has a bunch of other companies trying to compete with it and trying to beat it out over the next 5-10 years, right? So at the end of the day, like I can understand if the flood to Dow type stocks and those dividend stocks, if you can't get anything from the government, right? And then you can't get anything from the bank account. But now, look at the savings rate you get from countless of these companies. Look at Ally's savings rate now and these other different companies, right? Look at what you're getting for government. It doesn't make sense to, if you're thinking about risk, like putting money in a lot of those Dow stocks, it doesn't make financial sense anymore, okay? So they should not be trading at any significant premium based upon any sort of dividend yield or anything like that, okay? Next thing up, balance sheets. You might think, well, these companies, they're so big, they got such incredible balance sheets. Baloney, okay? BS, as in balance sheet, baloney, okay? No, matter of fact, a lot of these companies have some of the worst balance sheets you'll find out there, okay? Verizon, look at this company's balance sheet. $15 billion in current debt due for this company. $100 and almost $33 billion of long-term debt on this company. $174 billion of total debt on Verizon, right? An absolutely extraordinary number. Now, keep in mind, Verizon hopefully should be able to pay that back over time, right? They should, as long as people keep paying their cell phone bills and things like that. But I can tell you, look at Verizon's earnings and tell me how many years it will take if Verizon was to only spend money to pay off debt. Tell me how many years it would take for that company to get to a place where they've paid off all their debt, okay? That's something very important to keep in mind in regards to these companies. A lot of these companies are massively debt-loaded companies that if they wanted to literally pay off their debt, it would take them sometimes years to pay off all that debt, okay? And that's without paying dividends or doing anything else like reinvesting in the business, marketing. Look at Intel, right? Intel's got $2.2 billion of current debt due. They've got another $37 billion of long-term debt on this company, right? Intel's a decent-sized company, but it's not some massive, insane sized company, right? Intel's market cap now is around the same as AMD, right? And AMD virtually has, let's call it a very minor debts whatsoever compared to their market cap. But you look at something like Intel, it's pretty big numbers there, right? You look at a stock like Apple, right? Steve Jobs always believed Apple should not have debt. He always kept that company's balance sheet as clean as possible over the years. But after Steve Jobs passed on, right, some of the things that Steve Jobs believed in started to go away with Apple, right? And one of those is things like share buybacks, which Steve Jobs was not in favor of. Things like, obviously adding a ton of debt to the balance sheet that wasn't necessary. It's not like Apple's ever needed to add debt. That's the thing. This is like the most insane thing, because Apple's never, they shouldn't have any debt on this balance sheet, to be quite honest. It's not like they've been in financial jeopardy or like, crap, man, we don't have the money around to go reinvest into this or do that. The reason they have so much debt now, $21 billion of current debt, another almost $99 billion of long-term debt. The reason they have so much debt nowadays is simply because they've used so much money to buy back its own stock. And that's why they've added so much debt over the years, right? Now, keep in mind, as long as people keep buying iPhones and all those sorts of things, they'll be able to hopefully pay back that debt over the coming years. But it is just something to keep in mind that a lot of these companies are extremely debt-ridden companies now at this point in time, and even a great company like Apple that you would never think about being in debt, right? Has like $100 billion, if not more than that, in debts on this company's balance sheet going into 2023, right? Not a small number. Keep that in mind, right? Next thing up here, let's start going through valuations, okay? So the biggest stock in the Dow in terms of weight is a company named United Health, right? Number one Dow stock. And if you look at this company, the fact is, it's in a bubble. It's in a bubble. And it's been in a bubble here for a bit. And a lot of times stocks can be in a bubble for sometimes 1 to 3 years before it finally pops and everybody realizes, oh my gosh, that was stupid. What were we doing paying that price for that stock, right? And the fact is, United Health is a stock that if you can get it under 10p, you're doing well for yourself, okay? If you can get it between a 10 and a 20, okay, that's good. If you have to pay over a 20 for a company like United Health, you're flat out getting ripped off, okay? You're flat out getting ripped off for that stock. And folks are obviously recently paid way over 20, okay? The fact is this stock needs to come down between 30 and 60%. 30% minimum to even begin to get into the normal range where it should be, right? And I mean, I don't know if it'll ever fall back down here again, but do the math on what needs to happen to that stock price to get back down to those levels, okay? Home Depot, HD, that's the number 3 biggest Dow stock out there. It's much worse than it looks, okay? So basically, Home Depot, if you can get it under 15p, you're doing great for yourself. If you get it between a 15 and 20p, that's pretty fair, okay? So right now, it's at about a 20p. So it looks like, okay, maybe it's a little overvalued, but it's not a bubble. It's much worse, and I mean much, much worse than it looks in regards to this, okay? The fact is, if you look at Home Depot's revenues over the years, right, it's gone from $74 billion of revenue in 2013 to 2022, 151. It's an extraordinary move there, and just revenues climbing, right? For not the most innovative company, like, let's just be quite honest about Home Depot. Like, the Home Depot I go into nowadays as a 33-year-old adult is very much the same Home Depot I remember going into as a kid with my dad, okay? Like, it's very much a very similar experience. It's not like they've changed up much, right? They may add a few new products and services here and there, but it's not much different, okay? But they've been the biggest beneficiary of something that I don't think a lot of people fathom or really understand. And this is why it could hurt Home Depot's valuation, not just next year, but for several years going here in the future. The fact is, this company has benefited massively from this thing right here. This housing starts, okay? The housing market's been booming for years now, okay? We troughed the housing market around 2011, roughly, right? We went through a very big housing downturn because we got way overbuilt with housing, right? So then we went through a big downturn, and then for basically the past decade, it's been boom, boom, boom again, okay? Build homes, right? And housing starts climb to obviously epic levels. And something has happened very recently. Housing starts have started drop, and it's probably going to get a lot worse before it gets better in regards to housing stocks, okay? And it starts. I think we're overbuilt right now, and I think we're going to get a lot more overbuilt as all these homes get done, all these apartment buildings get done, and things like that, okay? The amount of construction that's gone on over the past few years because of the 0% interest rates, pretty much, it's ridiculous, right? And so this is going to hit Home Depot's numbers in 2023. This is going to hit Home Depot's numbers likely in 2024 also. It'll likely be several years. And if you go back to Home Depot's revenues in the housing bubble, essentially, right, and you're going to see a very similar trend. And so what's going to likely happen with Home Depot is their revenues are likely going to go down and their earnings per share is also going to go down, right? Now, if you're talking about a situation where folks' home prices also are going down and it's much more expensive to borrow money, which is what most folks do to, basically do a renovation of their homes. People are renovating their homes when their housing value is going down. And that's what's starting to play out now. Okay. So what's going to happen for Home Depot in 2023 and 2024 probably as well is that a lot of their business that they had with home renovations is going to go like this. Okay. And obviously, if you're talking about construction in general, slowing down massively in 2023 and especially 2024, it will hit Home Depot's numbers significantly. Not a little bit, significantly. And so that's a stock that looks like, oh, it might just be a little overvalued, but actually it's way, way overvalued. And it's actually in a bubble right now because of the bubblicious housing market we've had. And anybody that wants to tell me we haven't been in a housing bubble for the past couple of years here, wake up, okay? Wake up. The star of the show, McDonald's, the number 4 biggest Dow stock out there. This is a company that is trading at 30-ish PE, somewhere around there roughly. Usually, if you're getting around a 20 PE for McDonald's, that's fine. Okay, it's not like you're getting a great deal on it, but that's fine. If you're getting a 10, McDonald's for a 10 PE, 12 PE, 14 PE, then you're getting pretty good pricing on McDonald's. And you should see a nice return on investment between hopefully some capital appreciation over the coming years, as well as dividends, okay? But the fact is, this company is in its own little bubble world right now. Absolute bubble, okay? And it needs to come down massively just to get into normal ranges. Now, if you could go through the entire Dow list of the Dow 30 stocks, okay? And what you're going to find is most of those companies are trading at a 50% to 175% PE premium versus where they were trading at 10 years ago, okay? Now, keep in mind, this is in an environment now with the Fed obviously raising rates so aggressively that if anything, stocks shouldn't be trading at big premiums right now. And those stocks are trading at, and once again, this is just based upon what actually matters for these sorts of Dow stocks. You're always going to value them based upon PE and PE first and foremost, always for these companies. And they're trading at 50 to 175% premiums for PE. It makes no sense. And I mean 0% sense for anybody that understands anything about valuing companies. Absolutely nonsense, okay? And these stocks all need to fall in an epic way, okay? Now, let's talk about when I think this is going to happen and all those sorts of things, okay? And let me put on my tinfoil hat for a second. I should have got some foil and put a little tinfoil hat. If you know me, I'm not a massive conspiracy theorist, okay? And, different thoughts and ideas, okay? But I got to say, I do have a little tinfoil hat in this situation, okay? Because my belief is, I do almost feel like there's certain folks that have so much influence and power, maybe it's the government, maybe it's Wall Street in general, that they don't want certain things to happen at certain times for certain reasons. But once you get past this little area, they'll allow it to essentially play out, okay? And so let me show you something back to the great financial crisis, right? And what you're going to notice is, Wall Street couldn't really stop the market from falling. I mean, it was so bad. Obviously, all the banks were failing left and right. We almost lost the entire financial system. The market ended up dropping, obviously, off a cliff. They really couldn't save it, right? But they did try to save it for a little bit to save some face, right? And if you look at right into the year end, they try to boost this market up. For whatever reason. Why? I don't know, okay? Was it because everybody, for the most part, looks at their year-end tax returns and gets those emailed to them or sent to them in the mail, and so they wanted to try not to look as bad as it really was that year? I don't know, but the market suddenly came back for really no reason, okay? And then suddenly, literally as soon as January started, it was like, okay, you're allowed to tank the market again. And as soon as the new year started, they tanked the market in an epic way again. Why not just continue it down for that time? Why do you need to boost it back up into year end just to tank it again? Literally, there was no massive news that comes out. Anybody that knows anything about the kind of the news cycle, there's no massive news that comes out in the first week of January that all of a sudden you tank the market. No, it doesn't make sense, okay? And so for all of a sudden the market to do that was very strange, right? And basically the market dropped 26% in the first 3 months of 2009 when no one was looking except market participants, right? But the fact is the masses don't pay attention to 3-month spans of the stock market, okay? The masses pay attention to kind of like what happens year over year if they're paying attention to the market. They like to open those year-end investment reports and see, oh, how much was my account up or down this year, right? And they're going to see it's down probably 20% this year or so, because that's what the S&P 500 is down this year. Instead of seeing it's down 30 or 40%, 20% people are like, oh man, it's pretty bad out there. 30 to 40% people freak out. And they're like, what's going on with the people that are politicians? Because at the end of the day, what people blame it on, they're going to blame it on the president. They're going to blame it on, they don't understand really the Fed. The masses don't understand the Fed. They don't understand how Wall Street works. They don't understand valuations. They don't understand any of that. Okay. The masses are going to say, what's going on with the guy in office? What's going on with that administration, right? And so that's who always gets blamed for these things, from the masses. That's just the way it is. It's the way it's always been. And unless we get a super educated, which they're never going to allow the masses to be educated like that. That doesn't seem like realistic at all. Look at the school curriculums and things like that. It doesn't seem like they're ever going to allow the masses to get educated on that sort of level of like understanding what the Fed actually does and how much they play a part in this and how little actually the folks in office have to do with any of this. But at the end of the day, those folks get blamed, right? And so if you are in office, you're definitely in favor of them trying to hold the market together into year end. And then after that, you can do whatever you want. If you want to tank the baby, but just make sure that baby tries to recover before the end of the year. And you see this play out many, many times. And so it's just very interesting. So I wouldn't be surprised. And listen to these Wall Streeters talk, right? I watch so much CNBC all the time. And I hear these Wall Streeters come on and they're all talking about, the first half of 2023 is going to be bad. They don't say it like that, but they talk about there's going to be tons of volatility in the market. When Wall Street has these kind of like secret little like terminologies they use, okay? When Wall Street's telling you it's going to the market's going to be super volatile, basically they're saying the market's going to tank in the front half of the year, okay? That's basically what they're saying. And my question is, why wait till Q1? Why not tank it now? Seriously, why are we waiting until Q1 to tank the market? Why not get it out of the way right now? What are they waiting for? Oh, they don't want people to see those year-end investment reports and see the S&P 500 down 30, 35, 40%? So let's wait till Q1. Then we'll tank the market. Then we'll tank the Dow. Then we'll tank the S&P 500. Then we'll tank Apple another 20%. But wait just a moment, okay? Because at the end of the day, the masses don't really care about Tesla stock. There's a lot of people on the internet that might care about Tesla stock. There's a lot of retail investors like you and me. But we understand we're like this big of a population of like this much, okay? The masses care about just the S&P 500 and the Dow in general. That's what they pay attention to. And the Dow is huge. Like everybody looks at the Dow. Most people are invested more in the S&P 500. But in terms of what everybody actually pays attention to, if they even look at any number, it's the Dow, okay? And so at the end of the day, it seems like they're trying to like hold the show together even though they know what's coming. And so, I don't know, maybe it's Q1, all of a sudden you see an absolute tank in the indexes, right? The Dow, S&P. And wouldn't that be interesting? Remember this. Remember what I'm talking about right here. So if that happens, you can say, oh man, this is so similar to 2009. They try to hold the show together for whatever reason, and then as soon as the year started, sell it all. I don't know, man. It's just very, very interesting to see how that works out. But nonetheless, there's a massive, massive bubble out there right now, folks. We might have thought we got through it all, and we've gotten through most of it. But unfortunately, we do have a bit more. Oh yeah, I forgot. I put this slide together. Like, why wait? Why wait to dump it? Why are they trying to hold this show together? Why are they trying to hold this show together? Why wait till Q1 and Q2 to dump it? Like all these folks are saying, man. Oh, you got to ask yourself these questions sometimes, right? And I know it feels a little tinfoily hat, and but sometimes you do have to think about these things, right? I think it's probably important, and we'll see how it all plays out. But anyways, guys, appreciate you joining me. Much love as always. Thanks for being subscribed, and have a great day. I'm loving it.